President Trump is getting set to announce his replacement pick for Chair Jerome Powell, who's been chair of the Federal Reserve now for 8 years. Governor Stephen Myron is going to be rolling off the committee at the end of January. Whoever replaces him could be the person that the president nominates as the chair, although he could also pick somebody who is already on the FOMC. We'll talk about how the FOMC works, why the chair is such an important position at the FOMC, and then talk a little bit about what the Fed faces as it looks out to the rest of 2026. The betting markets have been very entertaining on trying to guess who the president will nominate. Again, this is not betting on who the next Fed chair will be. It's just betting on the nomination. There's been a lot of volatility around this, mainly because the president has publicly floated people and then seemed to pull them back at various stages during this process. His current economic advisor, Kevin Hassett, was seen as a prohibitive favorite just a few weeks ago. He has now fallen off the map as the president has publicly commented that he thinks he'd prefer to keep Hassett in his current job, although that obviously could change. More recently, we've seen a surge in the odds for Rick Rieder, who is a fixed income CIO at BlackRock. He'd be a very unconventional choice, although obviously somebody who has a lot of credibility with Wall Street. Former Fed Governor Kevin Warsh also seen as being in the running, as well as current Governor Christopher Waller, who dissented from the most recent meeting in January, favoring a rate cut. Tells you that probably thinks he needs to dissent in favor of cutting rates as opposed to keeping them on hold, which is what the Fed ended up doing in order to keep himself in the running for this job. The president obviously would like interest rates to be lower, as he's said on many occasions. Scott Bessent also publicly had disavowed any interest in the job, seen as a low likelihood pick, although it wouldn't be out of the realm of possibility. The reason why the chair matters so much is that when the president nominates a chair, this is the chair of the Federal Reserve System. This person has always also been the chair of the Federal Open Market Committee, which is the committee at the Fed that decides on monetary policy. That's run by 7 members of the Board of Governors and 5 Fed presidents at any given time. So there's 12 votes total. The chair is only one of those votes, but historically the chair has been somebody who can be very influential. You don't tend to see a lot of dissents from the decisions, and you certainly don't see dissents where the chair is dissenting from the rest of the committee. Other central banks around the world, you see that a little bit more often, but it's very, very unusual at the Fed to get more than even 1 or 2 dissent. So the chair does have a lot of centralized power. The Fed obviously does a lot of other things as well. The thing that markets spend the most time focused on is the Monetary Policy Committee. You can see the members here for 2026. So there's 7 members of the Board of Governors who are permanent voting members. The president of the New York Fed has a special position as vice chair of the FOMC. That person always gets a vote as well. And then there are 4 presidents of Federal Reserve banks who have a vote in any given calendar year, and then they rotate off and a new slate of 4 comes on. So these 2026 members have just started voting. They were not voting members last year, and that will change every year. And so the makeup of the committee does change from time to time simply because of who's rolling on and who's rolling off. What's interesting about the Fed is the Fed really sets short-term interest rates. They can set the overnight rate for basically cash, and every other interest rate in the economy to varying extents is priced off of that interest rate. You can see here, the black line is the Federal Reserve's policy rate. The blue line is the 2-year Treasury yield. That line is very close to the black line at any given point because the Fed has a lot of control over short-term rates. If they don't like something that's happening in the short-term Treasury rate market, they can make an announcement, they can verbally intervene, they can decide to cut rates further or raise rates further, whatever they've been doing to try to bring the market to heel. The lighter green line is one that's tied to the 10-year U.S. Treasury note yield. That is much further out of the direct control of the Fed. Yes, there is, obviously, you can see there's a relationship here. When the black line is moving up and down, the green line will tend to respond. But there's been various points over the last several decades where the Fed has faced sort of a conundrum, as former Chair Ellen Greenspan put it, when the 10-year is simply not responsive. So the Fed may be trying to get interest rates down, but the 10-year isn't moving down, as we saw this for a lot of the 2010s, for example. There's also been times where the Fed would prefer rates to go up, and the 10-year simply doesn't move up, and you end up with an inverted yield curve, which is often what occurs just before a recession. Right now, the yield curve is quite flat. You can see these are all bunched at relatively high rates, but all pretty much together. There isn't much to separate short and long-term interest rates, although long-term rates have come up a little bit as of late for interesting reasons. You can see on this chart, the blue line here reflects where the 10-year Treasury would be based solely on futures prices of where short-term rates will be over the next 10 years. So if you think you know, on average, where the Fed will have short-term rates over the next 10 years, you can make an approximate guess of what the 10-year yield should be at any given moment. But more goes into it than that. there's risks associated with owning a 10-year treasury as opposed to owning cash every day for 10 years. And that's where this black line comes in, this term premium, which had been very, very low, in fact, negative for most of the 2010s. This is part of the Fed's effort to get interest rates down, to do very easy monetary policy post-financial crisis. They've really only gotten out of that mode in the last couple of years with the interest rate hikes that started in 2022. This term premium has started to go up for a variety of reasons, but that is also meaning that the 10-year yield is a little bit higher than we would expect based solely on where the market expects the Fed to keep rates over the next 10 years. So there is still now this positive premium being paid to investors who are willing to lend to the government for 10 years, as opposed to those that really want to lend over much shorter periods of time. And this can be frustrating for the Fed that may want the 10-year yield to go lower. In fact, probably would like the 10-year yield to be lower as they've been cutting interest rates now for about 18 months. But it has refused to do so for reasons that are, again, largely beyond the Fed's control. And this isn't unusual, but at any given point, it's going to be difficult for the Fed, and particularly the chair, who can't muster all the votes he may need at any given time to enact any policy. There is obviously a committee-based approach here. Again, while the Fed chair has a lot of sway and may have very strong opinions, it's more of a challenge to bring his or her colleagues on board. The other thing is that markets don't always respond to Fed policy the way that the Fed might want and the way that we might expect. This is a chart of financial conditions. As this black line moves up, it means that financial conditions are getting easier, meaning equity market valuations are rising, credit spreads are compressing, the dollar is getting weaker most of the time. As these financial conditions ease, that's usually a sign that the Fed has been cutting interest rates. But you can see over the last couple of years, financial conditions tightened a lot in the first half of 2022 when the Fed was just gearing up. They anticipated the Fed was going to be raising interest rates, which it obviously ended up doing. But then from the middle of 2022 all the way through 2023, financial conditions actually eased. We know what happened to the equity market. It bottomed in the middle of 22 and then basically has been on a tear that it hasn't gotten off of now going on 3 or 4 years. You can see even more recently, we had the big tightening in financial conditions on Liberation Day in 2025. But since then, financial conditions have eased. Now, this is now consistent with what the Fed has been trying to do. The Fed's been lowering interest rates to try to get financial conditions to ease a bit. But there's no sign here that the market thinks the Fed is overly tight for sure, despite the fact that the Fed has started to put the brakes a little bit on expectations for how much and how quickly it's going to cut interest rates. Where we ultimately think this is going, regardless of who ends up being the Fed chair, and regardless of the different machinations that happen on the committee, one of which could be that Jay Powell stays on as governor for 2 years, even if he's not the chair. His governor term doesn't expire until 2028. This would be very unusual. We haven't seen this in recent memory at the Fed, where somebody would step down as chair and not also step down as a governor. But there's no guarantee that Powell is going to do that. He could potentially continue to be an influential voice on the committee, in addition to obviously whoever the chair becomes, and a handful of other very prominent members as well, who have been, like Chris Waller, like John Williams, are seen as credible voices, among the most credible voices on the FOMC. Lori Logan, president of the Dallas Fed and former manager of the System Open Market account at the New York Fed's Markets Group as well. A lot of experience in monetary policy. What they're all going to be looking at, though, is what's happening to the unemployment rate. We don't see inflation as being a major source of concern in 2026. If we're wrong about that, the Fed certainly isn't going to be cutting interest rates. But if inflation stays quiet or even decelerates a bit further down into that 2.5% range, it's really going to just be up to the labor market to decide for us and for the Fed how quickly and how much interest rates come down. We're seeing here that we have seen a rising unemployment rate. The blue line here is inverted to kind of be more consistent with what's going on with the Fed funds rate, to show you that more clearly. So when that line's moving down, it means the unemployment rate is moving up. If we could see 4.5%, 4.7%, certainly 5%, we would be looking at a much, much lower Fed funds rate, a lot of rate cuts. If we don't see that, if some of the data we've seen recently on continuing jobless claims coming back down is indicative of a pause in the slowdown in the labor market or re-strengthening, then we probably aren't going to see any more Fed rate cuts. There just won't be the support on the committee, again, regardless of who the chair is. So we probably shouldn't root for more Fed rate cuts, but we do want a Fed that's responsive to weakening in the labor market and will be willing to rapidly do what is necessary to get rates down and to reinstill confidence in the economy and the markets if it should come to that. We'll obviously have a lot more to say about this when we get a Fed chair nominee, and when that nominee has to go through Senate approval and ultimately takes the reins sometime in the middle of this year. Have a great rest of your week.